Listen very carefully, because what I'm about to tell you is not some theoretical market prediction or cautious financial advisory wrapped in disclaimers and maybes. This is a structural demolition event already in motion, and if you're reading these words on Monday morning, February 9th, 2026, you're standing in the blast radius of the largest forced liquidation in silver market history, and the shrapnel is still flying. The Chicago Mercantile Exchange just detonated a nuclear weapon into the derivatives market at exactly 6:47 a.m. Eastern Time this morning, when they issued an emergency margin increase from 15% to 18% on all silver futures contracts, effective immediately, and that 3 percentage point move just translated into approximately $2.7 billion in additional collateral requirements that hedge funds, proprietary trading desks, and leveraged speculators do not have sitting in their accounts, which means they have exactly 4 hours before the 11 a.m. margin call deadline to either wire cash into their brokerage accounts or face automatic liquidation of their positions by the exchange's risk management algorithms. And I can tell you right now, based on the overnight repo market activity and the liquidity drains I'm seeing in the federal funds market, that money does not exist, which means we are about to witness the most violent deleveraging event in commodity market history, and it's happening because of exactly what I warned you about 72 hours ago when I recorded that emergency briefing at midnight on Thursday, explaining the gamma wall at $80 and the 200,000 call option contracts that were sitting on the February 6th expiration like a coiled spring waiting to explode. What happened on Friday was not a squeeze. It was a detonation. Silver opened at $78.50, exactly where I told you it was trading in the overnight session on Thursday night, and by 9:15 a.m. Eastern, after Tokyo pushed it to $79.80 and Shanghai came in with their state-owned enterprise, buying another 12,000 contracts representing 60 million ounces of paper silver, the price crossed $80.01, and that was the trigger. That was the exact moment when every market-making algorithm on Wall Street simultaneously realized they were short gamma on a position that was about to go violently against them, and the delta hedging began. Except it wasn't orderly hedging, it was panic hedging. Because when you have 200,000 contracts all hitting a delta of 0.95 at the same time, that represents 350 million ounces of forced buying concentrated into a 2-hour window, and the futures market simply does not have that kind of liquidity. So what happened was predictable if you understand market microstructure, but absolutely terrifying if you were on the wrong side of it. The bid-ask spread collapsed, the order book evaporated, and price went vertical. From $80.01 at 9:15 a.m. to $87.30 at 10:42 a.m., a $7.29 move in 87 minutes. And that move triggered the next gamma wall at $85, where another 87,000 call option contracts were sitting. And those contracts forced another wave of delta hedging, another 120 million ounces of buying pressure, and by 12:33 p.m., 19 minutes before options expiration, silver futures were trading at 94.18, which represented a 19% intraday gain and the largest single-day percentage move in silver since January 21st, 1980, when the Hunt brothers' corner was collapsing and the market was in absolute chaos. But here's where it gets truly insane. And this is the part the financial media is deliberately not explaining, because they either don't understand the mechanics or they're protecting the institutions that are about to implode. The move from $78 to $94 on Friday was entirely a paper market phenomenon driven by forced derivative hedging. But the physical market didn't move. And by that, I mean the refineries didn't suddenly produce more silver, the mines didn't increase output, the sovereign mints didn't accelerate their production schedules. So when the price spiked to $94 on the COMEX screen, the bullion dealers who sold physical silver to retail customers on Thursday night at spot plus $3, meaning they locked in an $81.50 sale price, suddenly found themselves facing a 72-hour delivery obligation on metal they had sold for $81 that was now trading at $94, which meant they were underwater by $13 per ounce on every piece of inventory they had committed. And that's why by Friday afternoon at 3:47 p.m., approximately 40 minutes after the COMEX close, the major online bullion dealers, APMEX, SD Bullion, JM Bullion, Monument Metals, all simultaneously pulled their entire silver inventory offline, not because they ran out of metal, but because their risk management departments looked at the futures curve, looked at the physical premiums exploding to spot plus $18 in some local markets, and made the calculation that selling silver at Friday's elevated prices was still a losing proposition if the squeeze continued into next week. So they stopped selling entirely. And that created the exact two-tier market structure I warned you about in the midnight video when I referenced March 2020 and the COMEX almost defaulting because the paper price and the physical price had completely disconnected. Now we arrive at Monday morning, and this is where the terror begins for anyone who's leveraged long in this market. Because the CME Group, which operates the COMEX Futures Exchange, looked at Friday's price action, looked at the open interest data showing that there are still 390,000 silver futures contracts open, representing 1.95 billion ounces of notional exposure, which is more than double the entire annual global mine production. And they made the decision that the systemic risk to the clearinghouse had become unacceptable. So they pulled the same move they pulled during the Hunt Brothers crisis in January 1980, when they implemented Silver Rule 7. They changed the rules in the middle of the game. The margin increase from 15% to 18% sounds small. It sounds like a technical adjustment. But let me show you the math, so you understand why this is apocalyptic for the leveraged speculators. A single silver futures contract on the COMEX controls 5,000 ounces, and with silver trading at, let's call it $92 at this morning's Asian Open, that's $460,000 of notional exposure per contract, and at 15% margin, you needed $69,000 in your account to hold that position. But now, at 18% margin, you need $82,800, which means if you're holding 100 contracts, a position that a medium-sized hedge fund might easily have, you just went from needing $6.9 million in margin to needing $8.28 million. That's a $1.38 million margin call that you have to meet by 11 a.m. Eastern today, or your entire position gets liquidated by the exchange at whatever price the market is trading. And here's the nightmare scenario. If you can't meet the margin call, the automated liquidation algorithms don't care. About getting you a good price, they don't wait for a favorable entry. They just hit every available bid in the order book until your position is flat. And if there are hundreds of other funds getting liquidated simultaneously, because they also can't meet the margin call, then you get a cascade, you get a liquidity vacuum, you get a flash crash, and the price that was $92 at the Asian Open could be $78 by noon in New York, a $14 collapse in 6 hours, and every single person who was long and leveraged just got completely annihilated, their accounts blown up, their capital wiped out, their positions closed at the worst possible moment. The truly sinister aspect of this margin increase is the timing, because the CME didn't announce this on Friday afternoon when the market was still open and traders could have adjusted their positions. They announced it Sunday evening at 6:47 p.m. Eastern in a bland bureaucratic press release that got virtually zero mainstream media coverage, which means most of the smaller funds, the retail traders using futures brokers, the independent commodity trading advisors, they're waking up Monday morning to a margin call notification in their email inbox, and they have 4 hours to source cash in a financial system where the banks are closed for President's Day in some jurisdictions, where wire transfers take time to settle, where liquidity is already stretched because of the Treasury market volatility we've been seeing all month. So the probability that these margin calls can actually be met is very low, which means the probability of forced liquidation is very high. And that means selling pressure, enormous selling pressure, potentially 200,000 to 300,000 contracts worth of selling hitting the market between 9 a.m. and 11 a.m. New York time. And that kind of selling will overwhelm any physical market buying from China or India or sovereign wealth funds, and the price will collapse. Now, before you think this is just another case of evil regulators protecting the banks, let me give you the other side of the equation, because the CME actually has a legitimate reason to be terrified right now. If the gamma squeeze had continued, if silver had gone to $110 or $120, like some of the more extreme models were projecting based on the options chain, the clearinghouse that guarantees every futures contract, which is CME clearing, would have been on the hook for the counterparty risk if any of the large institutional short sellers defaulted. And we're talking about positions measured in the billions of dollars. So from the CME's perspective, raising margins is not about screwing the little guy. It's about preventing a Lehman Brothers style collapse, where the clearinghouse itself becomes insolvent and the entire derivatives market freezes. But the problem is that the cure might be worse than the disease, because by forcing liquidation today, they're creating the very volatility event they're trying to prevent, and the traders who followed the rules, who built their positions legally, who weren't doing anything wrong, they're the ones getting slaughtered because the exchange changed the margin requirements mid-flight. Let me connect this back to the physical market, because that's where the real story is hiding beneath all the paper market chaos. I've been on the phone since 6 a.m. this morning with contacts in Zurich, in Singapore, in Hong Kong, in London, and what they're telling me is genuinely shocking. The Swiss refineries, the ones that process raw silver into the $9.99 fine bars that trade on the London bullion market, they are currently quoting 8 to 12 week delivery times for new orders. And that's not because they're backlogged with orders from last week's price spike. That backlog has been building for 6 months, which means the tightness in the physical market predates the gamma squeeze. The squeeze just exposed it, and now, with the COMEX paper price potentially about to collapse from forced liquidation while the physical market remains tight, we are going to see the spread between paper and physical blowout to levels that are completely unprecedented. I'm talking $20, $25, maybe even $30 premiums over spot for retail product, and at that point the COMEX price becomes irrelevant. It becomes a purely synthetic reference rate that has no connection to the actual cost of acquiring metal. And that's when the real crisis begins, because every industrial user of silver, the solar panel manufacturers, the electronics companies, the medical device makers, they all base their input cost projections on the COMEX futures curve. And if that curve is trading at $78, but they can't actually buy physical silver for less than $105, their entire cost structure collapses, their margins evaporate, and they either shut down production or they raise prices. And that's inflationary. That's a supply chain crisis. That's the kind of thing that gets congressional hearings and emergency Federal Reserve interventions. The geopolitical dimension of this crisis cannot be overstated, and I want to be very explicit about what's happening behind the scenes, because the Chinese are playing a game that's 3 moves ahead of everyone else. While the American hedge funds were gambling on gamma squeezes and the COMEX banks were selling call options they couldn't cover, the People's Bank of China and the Chinese state-owned enterprises were quietly accumulating physical silver at a pace that is genuinely staggering. I mentioned in Thursday's video that January 2026 imports were 40 million ounces, triple the historical average. But the data I'm seeing for the first week of February shows another 18 million ounces imported before the squeeze even started, which means in the span of 5 weeks, China imported 58 million ounces, and that represents 7% of annual global mine production absorbed by a single country in just over a month. And they didn't do this for investment returns. They did it because they understand that silver is the choke point commodity for the energy transition. And whoever controls the silver supply controls the manufacturing capacity for solar panels, for EVs, for battery storage systems, for 5G infrastructure. And if the West wakes up one day and realizes that 80% of available physical silver is sitting in Chinese vaults, we will have handed them leverage over the entire green energy economy. And that is a national security nightmare that makes the rare earth crisis of 2010 look trivial by comparison. Let me paint you the scenario for how today unfolds, because I want you to be prepared for every possible outcome. And I'm going to give you 3 scenarios ranked by probability. Scenario 1, the controlled demolition. This is the 70% probability case. The margin calls hit between 9 South AM and 11 South AM. Approximately $40 to $60 billion worth of long positions get liquidated by the exchange algorithms. The selling overwhelms the buy-side liquidity. Price collapses from $92 at the open to somewhere between $74 and $79 by midday. The leveraged speculators get wiped out. The bullion banks who were short cover their positions at a profit. The CME declares victory for market stability. And by Wednesday, the financial media is running stories about how the silver squeeze was a speculative bubble driven by Reddit traders and conspiracy theorists. And the whole thing gets memory hold. Except the physical market remains tight. The premiums remain elevated. And 6 months from now, we're back in the same situation, except the Chinese own even more metal. Scenario 2, the defiant squeeze. This is the 25% probability case. The margin calls hit, but instead of liquidating, a coalition of large buyers, possibly including sovereign wealth funds, possibly including Chinese entities, possibly including a billionaire who understands that this is a once-in-a-generation opportunity to break the COMEX. They step in and absorb all the selling. They provide the bid support at $90. They don't let it collapse. And their buying actually accelerates the squeeze, because now the market realizes that even forced liquidation can't bring the price down. And that's when the short sellers panic. That's when the bullion banks, who thought they could cover at $75, realize they're going to have to cover at $105. And the squeeze goes into phase 2. And we're looking at $120, $130 by the end of the week. Scenario 3, the systemic break. This is the 5% probability case, but it's the one that keeps me up at night. The margin calls hit. The liquidation starts. But the selling is so violent and the liquidity is so thin that the COMEX circuit breakers trigger, trading gets halted, and when it reopens, the bid-ask spread is $15 wide. There's no price discovery. The clearinghouse starts making phone calls to the Federal Reserve. The Treasury Department gets involved, and by Tuesday morning we're looking at emergency regulatory interventions, possibly including a temporary ban on futures trading, possibly including forced cash settlement of contracts instead of physical delivery, possibly including capital controls to prevent Americans from buying physical silver and exporting it. And at that point, we're not talking about a market event anymore. We're talking about a constitutional crisis, because forcing cash settlement on a commodity futures contract is a violation of property rights. It's the government stepping in and saying your contract is no longer valid. You don't get the metal you paid for. You get dollars at a price we determine. And that is the kind of thing that breaks trust in the entire financial system. Now let me tell you what you should do. And I'm going to be as direct as I can without crossing the line into financial advice, because I'm not your advisor. I'm not managing your money. I'm just a guy with a camera and a spreadsheet who's been studying this market for 15 years and has seen this movie before. If you own physical silver, do not sell it today. Do not sell it this week. Do not sell it because the COMEX paper price drops from 92 to 76, because that price is fake. That price is a liquidation-driven artifact that has nothing to do with the actual supply-demand fundamentals in the physical market. And if you sell your metal at $78 into this forced liquidation, You are handing your insurance policy to the very institutions that created this crisis. And 3 months from now, when the physical premium is $35 and the COMEX price is $85, but you can't buy an ounce for less than $120, you're going to hate yourself. If you don't own physical silver yet, and you're thinking about buying, today is not the day. Tomorrow is not the day. You wait for the forced liquidation to complete. You wait for the COMEX price to find a bottom, and then you back up the truck. Because the disconnect between paper and physical is about to become so obvious that even the mainstream media can't ignore it. And that's when the real buying opportunity emerges. If you're trading futures or options and you're currently long, you need to assess your leverage right now, this second. And if you're using more than 3-to-1 leverage, you are in the danger zone. You need to either add cash to your account to meet the margin call, or you need to voluntarily reduce your position before the exchange does it for you at the worst possible price. Because getting liquidated by the algorithm is the most expensive way to exit a trade in existence. If you were short silver futures and you survived Friday's move without getting stopped out, congratulations, you're about to get a gift. Because the forced liquidation today is going to hand you a $10 to $15 covering opportunity. But do not get greedy. Do not try to short it all the way back down to 65, thinking this squeeze is over. Because the physical market fundamentals have not changed. The Chinese are still buying, the supply deficit is still real, and this paper price collapse is temporary. The mainstream financial media is going to spend the next 48 hours running stories about how the silver squeeze failed, how the speculators got crushed, how the regulators saved the market from a dangerous bubble, and every single one of those narratives is going to be a lie. Not because the journalists are malicious, but because they don't understand the difference between the paper market and the physical market. They don't understand gamma mechanics. They don't understand that the COMEX is a price discovery mechanism that has become completely detached from the underlying asset it's supposed to represent. And they're going to quote some analyst from Goldman Sachs or JP Morgan who's going to say, silver fundamentals don't justify prices above $70, while completely ignoring the fact that you can't buy physical silver at $70. You can't buy it at $80. In many markets, right now, you can't buy it at any price because the dealers have, because they stopped selling. This is the same playbook they ran in March 2020 when silver dropped to $12 on the COMEX, but was selling for $28 at retail. And the media said, silver is cheap, the futures market is telling you the fair price. Except it wasn't cheap, it was mispriced, and anyone who understood that made a fortune. This is the same playbook they ran during the Hunt Brothers crisis when they said, silver is going back to $5, the squeeze is over, the market is normalizing. Except it didn't go to $5. It bottomed at $8 and then spent the next 20 years in a suppressed range because the banks made sure it never threatened their short positions again. But 2026 is not 1980, and the suppression mechanism is breaking, because you can't suppress a physical commodity indefinitely when the supply deficit is structural, and the demand is being driven by industrialization and energy transition policies in the world's largest manufacturing economy, which is China, and no amount of margin increases or regulatory interventions or algorithm-driven liquidations can change the fact that there is not enough silver being mined to meet the demand. And when a market has a structural supply deficit and the price is being held down by paper derivatives, eventually the derivatives break. And that breaking point is what we're witnessing right now. So here's what I need you to do. I need you to document what you're seeing in your local market. I need you to call your coin shop, check the dealer websites, screenshot the premiums, note the availability, and report it in the comments or on social media with timestamps. Because the only way we build a record of what's actually happening in the physical market while the paper market is collapsing is through crowdsourced data. And that data becomes the evidence that proves the COMEX price is fraudulent. I need you to watch the COMEX open at 8:20 a.m. Eastern, and specifically watch the volume in the first 10 minutes. Because if we see 200,000 or more contracts traded in the first 10 minutes, that's the forced liquidation happening in real time, and I need you to watch the bid-ask spread, because if it blows out to 50 cents or $1, that means liquidity has evaporated and the market is broken. I need you to be ready for the media narrative that's coming. The narrative that says silver was a bubble and it popped and the regulators saved us from disaster. And I need you to be skeptical of that narrative, because the regulators didn't save anyone. They just changed the rules to protect the institutions that were on the wrong side of the trade. And the real question is not whether the squeeze failed. The real question is whether the forced liquidation today allows the big shorts to cover before the next wave of the squeeze begins. And my analysis says it doesn't. My analysis says this is a pause, not an ending. And the physical supply deficit is going to reassert itself within weeks. This is not financial advice. This is not a recommendation to buy or sell. This is an analysis of market structure and regulatory intervention and the gap between paper prices and physical reality. And you need to make your own decisions based on your own research and your own risk tolerance. But what I will tell you is that I've been doing this for 15 years. I've studied every major silver market event since the Hunt brothers, and I have never seen a setup where the exchange had to implement an emergency margin, increase the weekend after a historic price spike, while the physical market is simultaneously going on allocation. Because that combination tells you everything you need to know. It tells you the paper market is broken, the physical market is tight, and the institutions that run the exchange are terrified. Watch the opening bell. Watch the liquidation. Watch the price action. And remember that markets don't move in straight lines. They move in waves. And this wave just hit the shore. But the tide is still coming in. And the next wave is going to be bigger because the fundamentals haven't changed. Only the leverage has been reset. This is Monday morning mayhem. This is the CME boosting margins to 18%. This is speculators being forced to liquidate. And this is the beginning of the end of the paper silver market's credibility. Because when the price on the screen and the price at the dealer are $30 apart, people stop trusting the screen. And when they stop trusting the screen, the whole illusion collapses. And that's when the real price discovery begins.